Imagine waking up tomorrow and seeing headlines like this: major companies announcing layoffs, markets falling, economic slowdown begins. For millions of people, a recession means one thing: less money coming in, jobs disappearing, and savings shrinking. But here is the strange part. Right now, the U.S. economy still looks relatively stable. According to the U.S. Bureau of Economic Analysis, the American economy grew about 1.4% in early 2026. Unemployment is sitting around 4.4%, according to the Bureau of Labor Statistics. So if the economy is still growing, why are economists warning about a possible recession? And more importantly, could a recession still happen in 2026? Around the world, economists are debating this exact question. Is the global economy heading toward another recession? A survey reported by Reuters found economists estimating the probability of a recession within the next year at somewhere between 16 and 35%. So it is not guaranteed, but it is also not small. To understand the risk, we need to answer three things. First, what exactly is a recession? Second, what warning signs appear before one? And finally, are those warning signs appearing right now? In simple terms, a recession happens when the economy begins shrinking. The common definition is 2 consecutive quarters of negative economic growth. When that happens, businesses begin earning less money, companies cut costs, hiring slows down, and eventually people start losing jobs. But recessions rarely appear overnight. Most of the time, they build slowly. Pressure builds inside the economy, and then suddenly, something breaks. To understand whether a recession could happen in 2026, we need to look at the past, because economic downturns tend to follow patterns. Take the dot-com crash in the early 2000s. In the late 1990s, technology stocks were exploding in value. Investors believed the internet would change the world, and it did. But many tech companies had almost no real profits. Eventually, the bubble burst. Between 2000 and 2002, the Nasdaq lost nearly 78% of its value, according to historical data reported by the Wall Street Journal. Thousands of tech companies collapsed, and the U.S. economy entered recession in 2001. Then came the financial crisis of 2008. This recession began in the housing market. Banks had issued massive amounts of risky mortgages. When homeowners began defaulting, the financial system started to crack. Banks failed, credit markets froze, and unemployment in the United States eventually reached 10% in 2009, according to the Bureau of Labor Statistics. It became the worst economic crisis since the Great Depression. The next recession arrived very differently. In 2020, a global pandemic shut down huge parts of the economy almost overnight. Travel stopped, businesses closed, and millions of people suddenly lost their jobs. In April 2020, U.S. unemployment surged to 14.7%. That was the highest level recorded since the Great Depression. Looking at these recessions, economists noticed something interesting. The warning signs tend to repeat. Some of the most common signals include rising interest rates, high inflation, slowing economic growth, weak consumer spending, and rising unemployment. When several of these pressures appear at the same time, the risk of recession begins to increase. And right now, several of these signals are appearing. Interest rates remain relatively high. The federal funds rate is currently around 3.6%, according to the Federal Reserve. Higher interest rates make borrowing more expensive. That slows down business investment, and it can also slow consumer spending. Inflation has also been a major issue in recent years. U.S. inflation currently sits around 2.4%, according to the Consumer Price Index published by the Bureau of Labor Statistics. That is much lower than the inflation spike of about 9% seen in 2022. But price shocks often leave lasting pressure on the economy. Another important factor is consumer spending. In the United States, consumer spending makes up about 70% of the entire economy, according to the Bureau of Economic Analysis. Recently, economists have noticed spending growth beginning to slow. Reporting from the Wall Street Journal suggests many households are becoming more cautious as borrowing costs remain high. When consumers spend less, businesses earn less, and economic growth begins slowing down. Another major concern is global debt. According to the Institute of International Finance, total global debt has reached around $348 trillion. That is the highest level ever recorded. Debt itself is not always a problem, but when interest rates rise, servicing that debt becomes far more expensive, and that creates pressure across the global economy. And in the last week, another factor has entered the conversation. Oil prices surged past $100 per barrel, with spikes close to $119, according to market reports cited by Reuters. Energy price shocks have historically played a role in several recessions. When oil becomes expensive, transportation costs rise, manufacturing costs rise, and even food prices increase. That reduces consumer spending power, and it can slow economic growth. If you want to understand why oil is so important to the global economy, we explain that in our previous Novigma video about why countries fight for oil. Here is something many people misunderstand. A recession can still happen, even if the economy currently looks healthy. Economic data often lags reality. Before the 2008 financial crisis, GDP was still growing. Before the 2001 recession, unemployment was still low. Turning points in the economy often appear suddenly. As economists at JP Morgan recently warned, the risk of recession remains elevated, while monetary policy stays restrictive. So, will there be a recession in 2026? The honest answer is that nobody knows for certain. But several warning signs are clearly present. Interest rates remain elevated, debt levels are historically high, economic growth is slowing, and energy prices are rising again. All of these increase the risk of an economic slowdown. But history also tells us something important. Recessions are temporary. Every recession in modern history has eventually been followed by recovery. New industries emerge, markets stabilize, and the economy begins growing again. If you want to understand the forces shaping the global economy, subscribe to Novigma, because the biggest economic stories are only just beginning.